All right, let's talk about investing. Specifically, we're going to tackle mutual funds, probably the single most popular way for people to get started. We'll kick off with the basics, the real ground level stuff, but stick around because we're also going to get into some expert level insights that might just change the way you think about your money.
So, you're ready to invest, right? You've got that feeling, it's exciting, but let's be honest, it can also be kind of overwhelming. Where do you even begin? Well, if that sounds familiar, you've come to the right place. We're here to cut through the noise and give you a clear roadmap. Okay, so what is a mutual fund really? The best way to think about it is like a giant potluck dinner for your money. You bring a dish, I bring a dish, hundreds, maybe thousands of other people bring a dish, and suddenly we have a massive feast. In this case, your dish is your money. You pool it with everyone else's, and a professional chef, the fund manager, takes all that money and buys a huge, diversified buffet of stocks, bonds, and other goodies. It's a really simple idea, but man, is it powerful.
But hold on. Before we get into all the nitty-gritty, the most important piece of this puzzle is, well, it's you. Seriously, what are you even investing for? Is it for a down payment on a house in a few years, or is this for a retirement, like way down the road? The answers to those questions are going to define everything else, especially how much risk you're willing to take.
So what's the big deal? Why are these things so popular? Well, for starters, you get a pro managing your money, someone whose full-time job is to watch the markets. That's a huge plus. Then there's diversification. You know that saying, don't put all your eggs in one basket? Mutual funds are literally built on that idea. Your money is spread out instantly. Plus, they're super affordable to get into, and if you need your cash, you can sell your shares pretty much any day the market's open. It's called liquidity, and it's a big deal.
Okay, now let's get into your investor toolkit. We're going to talk about one of the most powerful strategies out there for building wealth over time. It's called a systematic investment plan, or SIP for short. And honestly, it's all about one thing: making investing a simple, automatic habit.
The beauty of an SIP is its simplicity. You just pick an amount you're comfortable with, maybe $50, $100, whatever fits your budget. And you pick how often, which is usually once a month. Then you set it up to automatically pull that money from your bank and invest it. That's it. It completely takes emotion and guesswork out of the picture. You just set it and forget it.
And believe me, people are catching on. These things are exploding in popularity. Just to give you an idea of the scale we're talking about, in India, a place where this strategy is huge, a record-breaking amount, think over $3 billion went into these plans in a single month. That's insane. It just goes to show you how many regular, everyday people are using this exact method to build wealth for the long haul. So here's where the magic really happens. When that automatic payment goes through, it buys units of the mutual fund at whatever the price is that day. They call that price the net asset value, or NAV. Now, this leads to something really cool called cost averaging. Think about it. When the market dips and prices are low, your fixed amount of money actually buys more units. When the market is up and prices are high, that same amount of money buys fewer units. Over time, this smooths out your average cost per unit, which is just a fantastic way to manage risk without even thinking about it.
All right, so we've talked about the good stuff, the how-to, but now we need to flip the script and talk about what not to do. Because honestly, knowing how to spot the red flags and avoid a bad fund is just as critical as finding a great one.
So you got to be on the lookout for these danger signs. First up, if a fund is constantly underperforming its benchmark, that's kind of like its report card, the index it's trying to beat. That's a huge red flag. High fees, they're a silent killer for your returns. A lot of frantic buying and selling, what they call churn, can also eat away at your money with hidden costs. And a big one, if you read the fund's strategy and it sounds like gibberish, just walk away. Seriously. And that brings me to probably the single biggest red flag of all: fees. Every fund has what's called an expense ratio, which is just the annual fee they charge you. And you might look at these numbers and think, oh, what's 0.5%? But look at this difference between funds that are actively managed versus passive ones. That tiny looking difference can literally cost you tens, even hundreds of thousands of dollars over a lifetime of investing. It's a huge, huge deal. You also want to look at who's steering the ship, right? If the fund manager keeps changing every year or two, that's like having a new captain every leg of a long voyage. The strategy gets all choppy and inconsistent. What you really want is a steady hand at the wheel, someone with a consistent approach who's been there for the long haul.
Okay, now we're going to get into something really interesting. This is a bit of an expert-level insight, something that goes way beyond the usual beginner's guide. There's some fascinating research that's found a surprising secret ingredient that can have a huge impact on how a fund does, especially when the market starts to get chaotic.
And that secret ingredient is something called ESG. It stands for Environmental, Social, and Governance. Basically, it's a way of looking at companies and asking, are they responsible with the environment? Do they treat their people and their customers well? And is the company run in a fair and transparent way? The theory is companies that score well on these things aren't just good companies, they might actually be stronger, more resilient investments.
And this is where it gets really, really interesting. The research found that during the big market crash back in 2008, funds that focused on high ESG companies acted almost like a shield. They didn't fall as much, they held up better. But, and this is a big but, when the market started to recover and boom, it was actually the low ESG funds that did better. So what does that tell us? It suggests that a high ESG fund can be a fantastic defensive play when things are bad, but it might not keep up when the market is flying high.
Okay, that's a lot to take in, right? So let's bring it all home. How do we take everything we've just talked about and turn it into a simple, practical checklist you can use to make smarter choices?
So here's the deal. Stop chasing hot funds with amazing past returns. Research shows again and again that's a terrible way to predict the future. Instead, focus on these key things. First, fees. I can't say it enough, low fees are the best predictor of success. Second, the process. Does the fund have a clear, consistent strategy you can actually understand? Third, the people. Are they experienced, stable managers? Fourth, the parent company. Is it a firm that actually cares about its investors? And finally, price. Are you paying a fair price for what the fund actually owns? Focus on these, not last year's flashy numbers.
Look, at the end of the day, your financial future is a story that you get to write. Investing is just one of the tools you can use to write it. You now have the building blocks, the foundational knowledge, and you know the right questions to ask. So the only real question left is, what's the next chapter going to look like for you?